The U.S. Central Bank just made headlines by lowering interest rates for the first time in 4 years. This move has significant implications, not just for the economy, but for millions of Americans living their daily lives. With the key lending rate now sitting between 4.75% and 5%, whether you're looking to buy a home, take out a car loan, or manage credit card debt, these changes can have a direct impact on your finances. When you take out a loan, the interest rate determines how much extra you'll have to pay back on top of the principal. The Federal Reserve, often referred to as the Fed, sets the key lending rate, which is what banks pay to borrow from the Fed. This rate serves as a benchmark, influencing the rates that banks charge individuals and businesses. For more than a year, the interest rates hovered around 5.3%, the highest levels we've seen since 2001. It's important to note that these rates jumped significantly from near zero levels back in 2022 when the Fed started increasing rates to combat inflation. The recent cut offers some welcome relief to borrowers who have felt the pinch of rising costs, but this relief comes with a potential downside. Savers may see lower rates on their savings accounts as banks adjust to the new lending environment. So, what does this cut mean for you? For homeowners and those looking to buy, lower interest rates can translate to reduced mortgage payments. With mortgage rates already dropping slightly in anticipation of this move, potential buyers may find it easier to enter the housing market. This is especially significant given the rising home prices we've seen in recent years. For car buyers, the implications are similar. A reduction in interest rates can lead to more favorable financing options. If you're in the market for a new vehicle, you may find that you can secure a lower monthly payment, making it easier to afford that dream car. Credit card holders are also in the mix. While credit card companies may not immediately lower their rates, a decrease in the Fed's key lending rate could eventually result in lower interest rates for outstanding balances. This is a crucial consideration for many Americans who carry debt on their cards, as it could reduce the overall interest they pay over time. However, it's essential to acknowledge that these changes don't affect everyone equally. Let's take a moment to explore how various segments of the population view these shifts. Recent surveys have shown a mixed sentiment regarding the Fed's decisions. Homeowners generally welcome the cut, hoping it will lead to lower monthly payments and a more accessible housing market. On the flip side, renters express concerns about rising rental costs, which often correlate with interest rate changes and overall economic conditions. Students with loans also have a stake in this conversation. Many are hopeful that lower rates will lead to more favorable repayment options, reducing their financial burdens. However, with inflation still a concern, there's a lingering anxiety about job security and future economic stability. But it's not just Americans who are impacted by changes in interest rates. The global implications are significant as well. Many countries with currencies tied to the dollar, like Hong Kong and several Gulf states, often align their interest rate decisions with those made by the Fed. Therefore, a rate cut in the U.S. can influence borrowing costs in those countries, affecting everything from consumer loans to business financing. Moreover, the stock market often reacts positively to interest rate cuts. Lower rates mean that companies can borrow money at a reduced cost, allowing them to reinvest their operations and potentially increase profitability. Additionally, with savings accounts becoming less attractive due to lower interest returns, investors may shift their money into stocks, driving prices up. So, why did the Fed decide to cut rates now? The decision was influenced by two key factors: inflation and employment. Back in 2022, when inflation surged to the fastest pace since the 1980s, the Fed raised rates in an effort to stabilize consumer prices. Higher rates tend to cool demand by making borrowing more expensive, which in turn helps lower prices. However, as the economy showed signs of slowing down and unemployment rates began to tick higher, the Fed shifted its focus. Interestingly, while inflation is a concern, it seems the Fed feels confident that it is under control. Recent data indicates that inflation hit 2.5% in August, and officials are increasingly optimistic about the trajectory of prices. As such, they are now turning their attention to the risks posed to the job market and the overall economy. But what do Americans really want regarding interest rates? There's a clear desire for stability and predictability. Many people hope for lower borrowing costs to make housing more affordable, student loans more manageable, and car purchases more accessible. At the same time, there's a call for higher returns on saving accounts as people want to see their money grow, even if rates remain low. Thank you for joining us here. Until next time, goodbye.